Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about the 5 most common underwriting mistakes I see from newer investors. Underwriting is one of those topics where people often focus on spreadsheets, on formulas, and software. And yes, sometimes there are mistakes in the spreadsheets, but far more often, the mistakes are in assumptions, mistakes in judgment, and it's a failure to properly understand the risks. Unfortunately, during the years of cheap debt and rapid appreciation, a lot of people develop bad habits that worked out because the market wallpapered over those mistakes. A rising market can hide a multitude of sins, but eventually the market will test those assumptions. So let's start with the number one mistake, and that is underwriting to proforma instead of underwriting to market reality. This is by far the most common problem. A broker sends out an offering memorandum with projected rents, projected occupancy, forecast expenses, projected upside, and new investors take those numbers at face value. But the market doesn't care about what you think or what you hope. Market only cares about what tenants will actually pay. Today, in many cities, particularly markets like Austin and Nashville, owners are offering 2 months free rent, sometimes 3 months free rent. They're offering reduced deposits, free parking, all kinds of incentives just to maintain occupancy. So the key question is not what are the asking rents, the real question is what are the effective rents after concessions. Now, professional investors underwrite reality, not the marketing brochures. Number 2, ignoring the exit cap rate risk. A lot of investors spend a lot of time analyzing year one cash flow and very little time analyzing the exit. That's usually just the result of a simple assumption about what the exit cap rate is going to be, and during a low interest rate environment, those numbers did get compressed. Many people assumed they would stay that way forever. Some people bought at a 4% cap rate assuming that they'll be able to sell at that price. Well, that doesn't always work out. You see, valuation is extremely sensitive to cap rate. A very small change in cap rate can result in a massive swing in valuation. Let's say a property produces $5 million in net operating income. At a 4.5% cap rate, that property is worth roughly $111 million. At a 5.75% cap rate, the value falls to about $87 million. That's a $24 million swing simply created by cap rate expansion. And that has nothing to do whether the property is performing well or not. You see, your exit assumptions should be more conservative as uncertainty increases. Mistake number 3, underestimating capital expenditures. This is a huge one. It's one that I see often. New investors often focus on cosmetic improvements because they're visible and easy to understand. But buildings are complete systems, and the real risks are often hidden behind the walls and underground. We're talking about the infrastructure, electrical systems, elevators, mechanical systems, often drainage, roofing, fire suppression. Every building is a machine, and machines wear out. I often see people buying older assets assuming they need a light renovation, when in reality the property's had years of deferred maintenance. You see, the experienced investor asks a very different question. They don't ask what makes a deal look good. They ask what would kill this deal. That's a very different mindset. Number 4, assuming rent growth will solve everything. For many years, people got used to rent growth covering up operational mistakes. Weak underwriting was rescued by inflation. Now, I wouldn't necessarily bet against inflation because it's probably not going to disappear, but poor leverage decisions were often rescued by appreciation. Markets don't move in straight lines forever, and a weak deal structure cannot depend on perpetual rent growth, especially not in markets with a lot of new supply. Today, many developers are experiencing much longer absorption periods, they're experiencing rent concessions, and much higher carrying costs. Professional underwriting assumes that kind of adversity. You want a project that survives difficult conditions, not one that requires perfection in order to make it to the finish line. I always encourage people to perform sensitivity analysis. What happens if rents decline 10%? What happens if stabilization takes 18 months longer? What happens if expenses rise faster than expected? Could be insurance, could be property taxes. What happens if refinance proceeds are materially lower? Just because the bank decides to be more conservative this month and doesn't give you the loan proceeds that you were thinking. If the project collapses under moderate stress, then the project was never truly viable to begin with. And then mistake number 5, failing to stress test the debt structure. That mistake has wiped out a lot of operators in the last few years. Many investors focused only on the interest rate and ignored the refinance risk. They assumed floating rate debt would remain cheap indefinitely, and that was a catastrophic assumption. The debt structure matters as much as the real estate itself. A great property with bad financing can absolutely fail, and at the same time, a mediocre property with resilient financing can survive long enough to recover. So I spent a great deal of time analyzing debt coverage ratios, rate caps, extension options, maturity timing, yield maintenance from the lender, refinance conditions, and cash reserves, because ultimately, liquidity is what's going to give you survival. The market can remain irrational longer than some investors can remain solvent, and at the end of the day, underwriting is not about predicting the future, because no one can do that. Underwriting is about determining whether a project can survive being wrong. That's the real job. Protect investor capital first, generate returns second, and that's how you should build a sustainable business and long-term trust from your investors. As you think about your own underwriting process, ask yourself whether your assumptions are based on evidence or optimism. One of them creates resilient investments. The other one creates expensive lessons. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.